have to file our taxes. And, you know, every year, I know we do this every year. We've been doing this for as long as we've lived in the States, but every year, believe it or not, there are changes to the tax laws that, you know, either benefit us or, I don't want to say hurt us, but, you know, we need to know before we actually go on to file. So there are, you know, deductibles and things that we can legally take advantage of that will actually benefit us and our families. And I always like to, you know, have the privilege or have the benefit of hearing it from a professional before we actually, you know, go on with the action of filing our taxes. Tonight, we are privileged to have our very own Professor Atuahene, former Chancellor of the Exchequer or the Treasurer. This is his stuff. So I just want you to, you know, relax, enjoy the session, and then when he's done, he will open the floor for questions so that any questions that you have, you'll be able to present it to him and hopefully get answers before you actually file your taxes. So once again, thank you all for taking the time on this Friday evening to spend this your evening with us and your weekend with us. And with that, Prof, I'll let you carry on. I'll take over.
Prof, you are muted. There you go.
All right, thank you, everybody. I would like to first of all apologize for joining late. We've been trying to get on since 7 o'clock, and unfortunately we couldn't get on with my 3 different computers that I use. So I'm joining from my phone to make sure that we can go through this successfully. So pardon me, this is a nice workaround that I was able to do with Dr. Jacobs-Abbey. So I'm talking from my phone. So I'm going to have Abbey run through the slides so I can talk about the things that I have to talk about. So I don't know if you can share the screen for us to see what's going on the slides.
Okay, great. I think I'm sharing the screen. Can you guys see the screen?
Yes, I can.
Okay, great.
I cannot see the screen.
Uh-oh.
Oh, okay, I can see it now.
Okay. All righty.
All right, so the first thing that I'm going to talk about would be the, hold on 1 second while I pull another version here. For some reason, I can't see the screen. I can see the people, but I can't see the screen.
Okay.
Hold on.
Well, you can use your other computer to open and I'll just follow along with you.
Yes, I think that's what I'll do because the phone is different. So let me open a version from my computer. And when you go to the first page, it talks about my my background and what I do currently. As you can see, I'm the principal for Urbana CPAs, which is a CPA firm based out here in Frederick, Maryland. I'm also a tax consultant with Intuit TurboTax. I've been with them for 3 years. And I used to be an adjunct professor at Strayer University, as well as the University of Maryland College Park. In terms of education, I went to the almighty Adisadel College, as you all may know. It's a big thing for me. So anytime Adisco asks me to do something for them, I graciously do it for them. Right after Adisadel College, I went to the University of Ghana, Legon, and then I came over here to the United States and went to Montgomery College in Rockville, and then proceeded to the University of Maryland in College Park. I am a certified public accountant, certified to practice in the state of Maryland. However, when it comes to tax returns, I'm also certified to file taxes in all the 50 states, plus Washington, D.C. I do have other certifications as well. I'm a chartered global management accountant. I'm also an internal auditor, and I'm a fraud examiner. Why is that so important? It's important because, as Dr. Abbey said, you need to make sure that you are hearing from a trained professional. And I see myself as a trained tax professional to give you a trained tax advice. In terms of what we are going to be going through today, we'll be talking about the basic income tax formula. We'll also be discussing the filing statuses, what this means when we say adjusted gross income, AGI, as you all may hear about. If you use your tax professional, they always talk about the AGI. This is a very important number that you need to know. We'll talk about the standard versus the itemized deductions. We'll talk about some tax credits, and then I'll give you a couple of tips about how you can save money on your taxes. And then we'll look at the tax brackets, and then we'll do real life simulations of some tax situations. Hopefully, Pro will be able to walk us through that, because I want to give you practical applications on how you can do some of these things on your own. So when your tax accountant gives you your tax returns, you can also go in and do some simulations and come up with the same numbers. So the way the tax system works, if you put in the same information, you have to come to the same conclusion. So we'll do that at the end of the class. And then if you have any questions that you want to ask, we'll take your questions at the end. So here is the basic tax formula, okay? When we talk about tax returns for individuals, I want to emphasize this is the tax returns for individuals, not businesses. So within the tax system, we have individual tax returns and businesses. This seminar is mainly for the individual tax preparations, okay? So when we talk about your tax formula comes from your gross income, right? So we'll talk about gross income defined in the next slide, but any income that you make, right, that will go to the first line item called your gross income. And then out of your gross income, you're going to back out what we call the above the line deductions. People call it tax deductions. We call it above the line deductions. And then once you back out your above the line deductions, it brings you down to what we call the AGI, adjusted gross income, right? So you take your gross income, back out your above the line items. We'll talk about that shortly. And then that brings you to your adjusted gross income. Then you get your standard deduction or your itemized deduction. Is either or. The law says that is the greater of the two. So when you do your calculation, whichever is higher, you are allowed to use. The standard deduction is the amount given by the government to everybody, almost. And the itemized deduction is what you are allowed to itemize. So when you do those two calculations, whichever is higher, that's what you are allowed to use. And then out of that, you can back out your QBI deductions, which are called your qualified business deductions, to give you what we call your taxable income. Once you arrive at that number, let's say that number is $10,000, you're going to multiply that by your tax rate to give you your gross tax liability. And then you back out your tax credits to give you the amount of refund that is due to you or the amount of money that you owe to the government. Does that make sense so far?
Yes.
Thank you. So this is your basic income tax formula, and that is written in the software. So regardless of the software that you use, HR Block, TurboTax, all these different software, or when you go to your tax accountant, this is a formula that is working behind the scenes, okay? Now let's talk about income. What is income? So from an IRS perspective, income is every income that you make, okay? Whether it's a legal source of income or illegal source of income, every source of income that you make is considered income to you. You don't care whether you made it through a legal means or illegal. The IRS doesn't care, right? If it's illegal, then that's something separate for you to deal with the law enforcement. And income is classified under 4 different categories. You do have ordinary income, portfolio income, passive income, and gains, okay? So this is defined as the fair market value of property or services rendered or cash received, okay? So let's talk about ordinary income. Most of us are workers, right? Most of us go to work, and then we get what we call wages and salaries. Those will come into that category as ordinary income. And then at the end of the year, you get something called your W-2. So if you haven't gotten it by now, you should be looking out for it. It's called your W-2s. That is what your employer gives to you at the end of the year. For those who are contractors, you get something called the 1099 NEC, non-employee compensation. And then for those who are retirees, you get something called the SSA 1099. All those are classified as ordinary income. Then when you come to your portfolio income, you have your 1099 INT. INT means interest, or your 1099 dividends. So as long as you have a savings account at the bank and you make some interest in this current interest rate environment, most of you who have money in your savings account should be looking out for a 1099 INT or a 1099 dividend if you do have investments. So do not file your taxes until you've checked the tax forms on your bank, online banking, to make sure that you don't miss that, because we are in a high interest rate environment. And in this current interest rate environment, majority of the people who have money sitting in their savings account should expect to receive a 1099 INT. All right? If you didn't get it in the past, that was because we were operating in a close to zero rate environment. Now I've seen interest rate go as high as 5%. So if you have $20,000 sitting in your savings account or any other CDs, you should expect to receive something from your bank. Most banks don't give those out these days. So you have to go to your online banking and walk through the tax forms to retrieve that document. The third set of income is called passive income. So for those who have tons of money and have extra houses that they rent, that is classified as a passive income. For those who have businesses, that is classified as partnership. You also have passive income in those partnerships. You could be part of a partnership, but you could be a limited partner, right? That means that you don't take part in the day-to-day running of the company. The general partner takes care of that, and the limited partner stays in the background and put money into it. You could also have royalties coming from different sources, music, anything. That is an activity that you involve in passively. You are not actively involved in. So you should also expect to receive either a 1099 or a K1 from your partnership interest. And then the last set of income is called your capital gains. So capital gains are usually investments, right? So if you do any form of investments and you have a gain, you should expect to receive a 1099B. If you sell your house for a gain, you should expect to receive a 1099S for the sale of the house. Any questions so far? Do we have any questions? Prof?
We're good.
All right. Now we are going to go to your adjusted gross income. I always going to take you back to the formula, right? We just spoke about your gross income, which was on page 6. We are going to go to the above the line item, which is your adjusted gross income. So for your adjusted gross income, that is subtracted from your gross income. If you are a teacher, we have something called the educator expenses that you are allowed to deduct. Any contributions that you made to your IRA's individual retirement account, you can deduct that. Any student interest loan that you paid, for those who have student loans, I believe you all started paying back your student loans in October of last year. So you should receive a tax statement for the interest that you paid. That is a deduction. So you have to wait for that statement to come in to help you reduce your taxes. Health savings account, which is considered a tax haven, that is above the line item, so you can deduct that as well. And then for those who have their own businesses, you can deduct your health insurance premiums. We used to have something called the fee and tuition and fee deduction that was up to $4,000. That has been deferred or canceled for now. Moving expenses. I remember moving expenses used to be deductible. That has been canceled. Now it's only down to the military folks. So if you're in the military, you can deduct your moving expenses if you move from one state to another. Of course, with all these rules, there are different counter rules to it, right? So you have to meet certain criteria. So you have to talk to your tax advisor to see if you meet those criteria. And then finally, if you are paying any alimonies and the agreement was prior to 2019, if you had that agreement prior to 2019, you can deduct that. Obviously, if you deduct your alimony that you pay, then whoever is on the receiving end has to report the alimony received as income. So it's got to be a two-way street. Alimony paid is a deduction for you who is paying in terms of a divorce, and then whoever is on the receiving end has to report that as income. The next set of sections that we'll be talking about would be your standard deduction or itemized deduction. As I said earlier on, we are going to use the greater of this. So every year, based on your filing status, I don't know if I spoke about the filing status. I think I skipped that. It was probably on the second slide. I missed that, but I'll talk about that now. Based on your filing status, you are entitled to a certain amount of deduction, which we call the standard deduction. We have 5 different types of statuses, all right? We have the single status. Pro, can you go to page 7? Where it says 5 types. So we have the single.
Yes, I'm with you on that.
We have the head of household. We have the marriage filing jointly, married filing separately, and then a qualifying widow or qualifying widower. Always put this in mind. Everybody who files taxes within the United States of America falls under these 5 categories. It doesn't matter what you are or what you think you are either married, filing jointly, married filing separately, you are filing as a single, you are filing as a head of household, or you are filing as a qualifying.
From this morning.
Hello? Did somebody say something?
No, I muted him.
Okay. Or you are filing as a qualified widow or qualifying widower. All right. So when it comes to the standard deduction, this is where it comes to play on page 10. So for the 2023 rates, right, every year this is adjusted for inflation. If you are single or you are married filing separately, you are allowed to take a standard deduction of $13,850. I repeat, if you are single or you are married filing separately, on page 10, you are allowed to take a standard deduction of $13,850. All right. If you are married filing jointly, then both you and your spouse are allowed $27,700 as a standard deduction. All right. And then if you are head of household, then you are allowed a $20,800 deduction as a standard deduction. Why is this so important? Let's assume that you qualify to file taxes as head of household, right? In this hypothetical scenario, you qualify to file taxes as head of household, and then you go and file as single, right? Doing the rough redneck math in my head, all of a sudden you're losing about $7,000, right? Look at the difference between $20,800 and $13,850. This is so important. So you have to make sure you are using the right filing status. Let's take another example. If you are married, right? If you are married and there's no issues with your spouse, you guys are living nicely, and you guys qualify to file jointly, and you decide to file separately. If you file separately, each spouse is entitled to $13,850. But if you file jointly, you are entitled to $27,000, right? So there's always an advantage of filing jointly. That is the highest that you can get. But the tax rule says that you are allowed to use the higher of the standard deduction or the itemized deduction. What does this mean in plain English? All right. So let's say I'm a single taxpayer and my standard deduction says 13,850. All right. 13,850. Look at the bottom of the screen for the itemized deduction. If I have a mortgage that I paid interest on, if I paid property taxes on my mortgage, if I had state and local income tax up to $10,000, if I had medical expenses in excess of 7.5% of my adjusted gross income, which is the AGI, or I did donate to charity, right, of which Adisadel Old Boys Association is a charitable organization, right? So whenever we ask you to send your donations in, you are allowed to claim them on your taxes, right? That goes into the classification as an itemized deduction, okay? So for the example that I'm giving, if all those itemized deductions, let's say my mortgage interest payment was $2,000, my property taxes was $10,000. These are all examples, okay? All of a sudden I have $12,000. My state and local taxes was another $2,000. All of a sudden I've got $14,000. I had medical expenses, which was in excess of AGI, which was about $1,000. I've got $15,000 in itemized deductions, and I made a donation of $1,000 to AOBA, $16,000 in itemized deduction. What the tax rule says is that you can use the higher of the two. If you try to use a single, you are going to get 13,850 in deductions. If you use the itemized deduction with the example that I just gave, you're allowed to use 16,000. So my question to you is, which one would you use? And I need a volunteer to give me an answer to make sure you guys are listening.
The itemized.
The itemized deduction, right? Because if you use $16,000, right, you have an excess of over $2,000 in savings, tax savings. So this is very, very, very important. The most important thing is your filing status. Make sure you are using the correct filing status. If you qualify as married filing jointly, do so. If you qualify as head of household, do so. Do not go file as a single if you qualify as head of household. If you have all these itemized deduction items that you can put together, which is in excess of 13,850, use that. If you're married filing jointly, of course, your itemized deductions will be more, right? So let's say if you're married filing jointly and your itemized deduction for both spouses is about $30,000. In this case, you're going to use a $30,000 itemized deduction instead of the standard deduction of $27,700. Okay? Now we are going to move to the next section, which is called the tax credits, which is what we all love. We all love some tax credits, right? So on the tax credit, let's go back to the formula on page 6. After you take out your itemized or your standard deduction and you get your taxable income, it applies to your tax rate, right? And then it gives you your gross tax liability. This is where the tax credit comes in, all right? And we are going to go through a couple of the tax credits. The good thing about the tax credit is that some of them are refundable tax credits, some of them are non-refundable tax credit. What does that mean in plain English? If the tax credit is refundable, that means that it will give you back money. If it's non-refundable, that means that it reduces your tax liability to zero. So let's say your tax liability is $2,000 and you have a refundable tax credit of $4,000, right? A liability of $2,000 and you have a refundable tax credit of $4,000. All of a sudden, you are going to get a $2,000 refund. I do get a lot of questions from people that say that, oh, why is it that when I file taxes, I don't make money? I've got to make money all the time. make money all the time if you have refundable tax credits, right? Because they are refundable to you. If they are non-refundable tax credits, your tax liability of $2,000 and you have a non-refundable tax credit of $4,000, it's going to reduce your liability to zero because it's non-refundable. So it will take $2,000 of the $4,000 that you have and bring your tax liability to zero because it's non-refundable, okay? So when the tax credits that we have, the biggest one that we have is the earned income credit, EIC. So earned income credit is a credit that's given to people who make less money, right? So this is a credit that is given to low wages, right? People, to encourage them to make more money, right? Because the system is so hard, what the tax code says is that, okay, these guys are not making enough money, so let's just give them back money. With the earned income credit, if you have kids and you are within the low income bracket, you also make more money. And that is why there's always a confusion of, oh, as the more money I'm making, the less taxes that I'm getting back after I file my taxes. Why? Because those in the low income bracket with kids have this credit called the earned income credit, which is a refundable tax credit. There's also the child and the dependent tax credit, right? So you hear people who have children saying that, oh, I'm getting a larger tax refund. They're getting a larger tax refund because they have the child and dependent tax credit. Of course, all these credits have different rules that apply. So you've got to follow those rules as well. There's the adoption credit. I filed taxes for last year. I filed over close to about 500 taxes. My personal business plus table tax. I've never seen somebody use the adoption credit yet. All right. So let's encourage ourselves to adopt people because the IRS will give you money to do the adoption. We've got the education credits for those who are in school. Remember to wait for your credits and get those credits. The foreign tax credit. So the way the tax code is written, as long as you are a US citizen or a national, your gross income is defined as your worldwide income, okay? Your gross income is your worldwide income. So if you are a US citizen or a green card holder living in Switzerland or living in South Africa, you've got to report your income that you are making, even though you are making it outside the United States as income, all right? So what the IRS says is that, or what the federal government says is that, okay, we are going to give you some foreign tax credits, okay? So for those who are making money outside the United States, there are some credits that they get to kind of offset their taxes that they are paying outside. There's a retirement savings contribution credit for those who are investing for their future. There's a general business credit, and then there's a green credit. All right, we are living in a green revolution. So for those who have installed solar in your houses or those who are buying electric vehicles, you do have some credits that you can take. It's great. I've seen somebody installed solar in their houses and they were able to get most of the money back. I've seen so many people take advantage of that for those who are using the green revolution. Any questions so far? Ropo, do you have any question in the chat?
Not yet.
All right. So whenever I teach my students and there are no questions, I always say there's two things. It's either they don't understand what I'm saying or they are not interested. So I don't know if it's one or two. I think Senior Arthur has a question. If you can't ask the question, you can type your questions in the chat.
Can you hear me? Can you
Yes,
hear
sir.
me?
Yes, you can go
okay.
ahead.
Okay. I mean, this is just a contribution with respect to the foreign tax credits. Apparently, not all the states accept it. So the federal government may accept it. I think right now it's like $120,000 of your foreign income. but the state in which you live, the state may not give you that credit when you do the state taxes as well. I found that with the state of Virginia. So those of you who make that money should find out whether your state also accepts that tax credit that's given by the federal government. They're going to add this. Yeah. Hello?
Stop it.
Hello. Hello.
Yes, yeah, Prof.
I'm done. I'm done.
Okay,
All right.
thank you, Senior George.
For some reason, I got kicked out. I'm sorry about that.
Should I repeat what I said?
Yeah, I think I overheard you saying that not all states accept the green credits.
Yeah, the tax credit, the foreign tax credit, sorry. The foreign
Yes.
tax credit, yes. Not all states accept it. So
Yes.
for the federal, yes, but not the state level.
Yes.
So we need to inquire, yes. Mhm.
Excellent. Yes, so that's a good point because this particular lecture is about the federal income taxes. Every single state have their own tax laws, which is different. So I'm glad you dropped that in. The state tax laws, some states are different from what the federal government does and vice versa. So thank you for adding that to it.
Yes, Paro, there's one question from Senior Alfred. And it says, when one spouse files as married filing jointly, does that mean the other spouse automatically does not file their individual tax for the year?
Yes. So when one thank you, Senior Alfred. When one spouse files as married filing jointly, they cannot file the return until you sign. So let's say there are two spouses, right? And one goes ahead to go to their CPA to go file their taxes and claims the marriage filing jointly. The tax accountant or the CPA is going to ask for the spouse's date of birth, social security number, and everything. And before those taxes are filed, the other spouse has to sign because it's a joint return. So you cannot file behind your spouse. Okay. Does that answer the question?
Got you. Sinafred, you can give us a thumbs up if that answers it. There's another question from Senior Aaron, and Senior Aaron says that do green credit apply to EV leases?
That's I've got to look into. I don't think it does, but I got to look into that and get back to you, Senior Aaron.
All right,
So
great. I think
this
that's
question
all.
is related,
Thank you.
is related to you leasing the vehicle as opposed to you buying the vehicle, right?
I think that's the intent.
Yes,
Yes,
that
so
was the
I'll-
question. Yeah.
Yes, so I'll look into it and post the answer back on the platform.
All right.
Thank you.
So I see another question
Quick
from
question.
Senior Kojo Kran. The rule about using the qualifying widow is a little bit straightforward. So in the year that you lose your spouse, let's take an example. If you lost your spouse in 2023, right? You are allowed to use the marriage filing jointly if that's what you've always been using in the year of death. Then you can use a qualifying widow or widower for 2 years after that. 2 years after that. So in the year of death, you can use the marriage filing jointly. Then the following year, you are allowed to use a qualifying widow or widower, and then a year after that.
Thank you.
Thank you so much. I think somebody was asking a question before we go back to the chat. Somebody was asking a question. do we have someone who was asking, unmuting and asking question?
Yes, that was me.
Okay, Stephanie, you can go ahead.
Just a quick question. You stated that married but filing separate or single is 13,850. And then married and filing jointly is 27,000, I believe. So if both spouses are filing separately, is there like a big difference? Because is that still not equal to 27,700?
No, it's not. When you do the tax calculation, if you do married filing separately, you lose, right? Because think about it, you have two incomes coming in, and then all of a sudden you are using a lesser standard deduction than if you would have used the joint return to get a 2,700. So the best filing status is the married filing jointly. So the IRS or the government encourages us to marry, and then they also want us to stay in the marriage, right? So the best filing status is that the marriage filing jointly, if you can. There are instances where the marriage filing jointly is not a good thing for the couple. One of the things that I see most people go through is, number one, when one spouse makes, like, is all the way in the highest income bracket, or when one spouse come into the marriage with a whole lot of debt with the IRS, and the other spouse don't want to get themselves involved in. Because remember, if you file your taxes and you have a debt with the IRS and you are due a return, you don't get it. When one spouse is involved in a fraudulent activity, or when one spouse wants to hide some income from the other spouse. So I've seen situations where I'll get a situation where a spouse has some other income that is coming from somewhere that they don't want the other spouse to know about, right? But when you file the marriage filing jointly, you've got to disclose everything, because if you do not disclose an income source, all of a sudden you're going to get a letter from the IRS.
So what if you want to do separately to avoid having to pay, like, for example, your student loan? If you're filing jointly, then they try to put the student loans together. Like, what if you don't want that?
So the rule says that you as an individual or you as a couple, you are allowed to use the filing status that will benefit you the most, right? So there's no punishment for using a filing status. They want you to think about your personal tax situation and use a filing status that will benefit you. So if married filing separately, it's what's going to benefit you, then do the math and use that. They don't go against that. As long as you fall within those 5 categories. Of course, if your spouse is not dead, you cannot use the married filing, the qualifying widow or widower, right?
Yeah.
But if you don't qualify for the head of household and you go and use that, that's a big trouble as well. But when it comes to the married filing jointly or the married filing separately, it's up to the couple to decide what they want to do.
Okay. Thank you.
You're welcome. Before we call, I think Emmanuel Sari, Sinasari, I think there was a question from Dr. Nyokai. He said, did you receive any credit for starting an LLC last year?
Is it a specific question towards me, or did he?
I think probably mean, do you?
So if you start an LLC, you do not receive any credit, right? If you start your own business, there's no credit, but there are credit that you can receive. Remember the general business credit that I spoke about? There's that you can claim on your taxes, especially if you are filing your business taxes with your individual taxes, right? So when you establish a business and you are a single member LLC, the IRS may consider you as something that we call a disregarded entity, which means that you can file your business taxes with your individual taxes on your Schedule C, or you can file the business taxes on its own. If you file the business taxes with your Schedule C, then you can get the general business credit, and then any self-employment healthcare premiums that you pay, you are allowed to deduct that as a credit as well, as a deduction, sorry.
Got you. Okay. I think Senior Sari, you can go ahead and unmute yourself and ask a question.
I think he answered it. I was wondering if you had filed, previously maybe as a head of household, maybe you switched to marriage filing separately, and now you want to do the marriage filing jointly, but I think you already answered that there are no consequences for that, except that probably if you use head of household and you switch, that's what probably something might happen. I don't know.
Yeah, the head of household, you have to be careful with that if you are married. Okay, you really have to be careful, because if you go to your tax accountant, they do have a form that they fill and attest to make sure that they question you to be sure that you qualify for the head of household. If you are filing as a head of household, right, and you are married and living in the same household, that is not great. But if you are filing as a head of household and you took care of the child, you supported the child for more than half of the year, you supported the child, and then the child lived with you, then you can file. But if you're all living in the same address, you've got to be very careful about using the head of household status. Probably the marriage filing separately will help you in that. Right, we have two or three more slides that we have to go through, and then we'll come back to the Q&A in the end.
Good. All right. So I'll ask that everyone, please hold on to your question. I'll note it down. We'll come back to the Q&A after the slides.
Let's go to the 6 tax saving strategies. I do have a little disclaimer there. Please contact your CPA or your tax advisor to look into your specific situation. Obviously, if you want me or my team to look into that for you, we can do that as well for a small fee. But everybody's situation is different, okay? So 6 tax savings advantage that you can legally do. The one that comes to mind is a long-term capital gain. Right? So for those who invest in businesses and stocks and all those things, I will please plead with you to hold those investments over the long term. Why is that so important? The short-term capital gain, right? So let's say if you hold a stock or an investment for the short term, what does short term mean? A short term means that you hold the investment for less than 1 year, okay, and you sell for a gain. So if you hold the investment for less than 1 year and you sell for a gain, these are your tax brackets. Your tax bracket goes from 10% all the way up to 37%, depending on your overall income. So you could pay up to 37% taxes on those gains. If you hold the investment for less than a year, for more than a year, the long-term capital gain, your tax brackets are 0, 15%, and 20%, right? So right off the back, you can save 17% in taxes for holding your investments for more than a year. That is what we call long-term capital gain. So if you're a high income earner and you know that there's a year that you are going to make less income and you have long-term capital that has gained, that has appreciated in value, you could decide and sell those investments then so that you can take advantage of this tax savings. The sale of your primary residence for those who have houses, right? If you stay in your house for more than 2 years, so if you do a look back for the last 5 years and you've stayed in your home for more than 2 years, it doesn't have to be 2 years conservatively. You can stay in it for 6 months, move out, come in, move out. But if the addition of those times that you stayed in your primary or secondary residence was for more than 2 years and you sell your house for a gain, if you are single, the first $250,000 is tax-free. Okay, so if you're thinking about selling your house, think about this. This is so important. You've got to stay in the house for 2+ years over the last 5-year period. If you're married filing jointly, the first $250,000 is tax-free. That is why a lot of people make money in selling their homes, because all this money is tax-free, okay? then any amount in excess of that will be considered a long-term capital gain. So let's say if you are married filing jointly and you sold your house and you made $750,000, the first $250,000 is tax-free, and then the next $250,000 will be taxed as a long-term capital gain at either 0%, 15%, or 20%, depending on how much income that you made. For those who don't know, your investment losses and your gambling losses are also tax deductible, right? So let's say 2 years ago, 3 years ago, somebody talked you into buying cryptos and you've made a massive loss. You are allowed to deduct up to $3,000 of those investments each year, right? You are allowed to deduct up to $3,000 in those investments each year, and that can go forward indefinitely. So let's say you lost $20,000 or $30,000. You are allowed to deduct $3,000 of those losses for the next 10 years. That is why it's so important to keep track of your losses. Gambling. If you make any gambling losses, you are allowed to deduct your gambling losses, but there's a key here. You can deduct your gambling losses to the extent of your winnings, right? If they do not put that key in there, then everybody can go in there and gamble and then write them off their taxes. So if you made a gambling loss of $15,000, but throughout the year you made a gambling winning of $5,000, then you're allowed to deduct $5,000 of the $15,000 that you lost on your taxes. For those who didn't know, now you know, right? You can deduct your gambling losses to the extent of your gambling winnings. For those who don't have IRAs, individual retirement account, this is a really good tax haven. Make sure you look into that. Your 401k at your workplaces, some workplaces provide that. Make sure you look into investing in either Roth or traditional IRAs. One of my favorite vehicles as a tax accountant, I started investing in HSAs just last year, but it has become one of my favorite vehicles. HSA is simply called the Health Savings Account. But for you to qualify to have an HSA, you've got to be in a high deductible health insurance plan. All right, so your deductible has to be high, and then you qualify to open an HSA. So one may ask, what is an HSA? An HSA is an account that you can open and use to pay for your medical expenses tax-free, okay? So if you have your HSA at your job, they take that money out before they even start taxing you. So let's say every 2 weeks, you make $2,000, right? $2,000 is your gross receipt. Before they take out the federal income taxes, the state income taxes, if you have an HSA for $500, they'll take it out of the $2,000 for your taxable income to come down to $1,500 before they start taking out your taxes. This is a very great tool. If you haven't heard about it, look into it, talk to your HR and see if you qualify. When they put that money into the account, that is tax-free. It's got something that we call the triple tax advantage. The money is going into the account tax-free. You can use it to pay, as long as you're using the money to pay for health care, right? Health-related stuff, it is also tax-free. Plus, the earnings on that money is also tax-free. So my HSA is with Fidelity for the family. Any amount that they put in there is tax-free. All the investment that they do and the gains and the losses, the gains on the HSA money is also tax-free. And then when one of the family members gets sick, they go to the hospital and they have pre-tax money there to pay for the healthcare stuff. And then I know ProPro's, one of ProPro's biggest saving vehicle is a 529 college plan. So that's also great. That is a college saving tool that you can set money aside for the kids to pay for their education in future. It doesn't necessarily have to be for the kids. It can be for yourself as well. So these are tax-free savings that you set aside. And as long as you are using the benefits to pay for education expenses, it stays tax-free. Obviously, there are, punitive things that goes if you don't follow the rules, right? Like with the HSA, if you use a card outside of the health sector, there are also repercussions to that. And then I also like to share the tax bracket. If you haven't seen this, this is a very, very good tool. When I walked you through the formula, there was one part of the formula that said tax rate, right? So your gross income minus your above the line deductions, give you your AGI, you back out your standard deduction, and then you get your tax liability, then you multiply by your tax rate. If you look at the far left side, those are the tax rates. There's a 10%, 12%, all the way through to 37%, right? So the 37 are the high income earners. So for single filers, if you make 578,125 or more, then you fall within a 37% bracket. If you make $11,000, $0 to $11,000 as a single filer, you fall within a 10%. For marriage filing jointly, right, all of a sudden, you have to make $22,000 to be taxed at a 10% rate, which is the one in the middle, the top middle. And then for the household, the head of household, that's $15,700, right? So this bracket is very key to calculating your income taxes. And then finally, this year, I told you earlier on that I wanted us to do something different. So, Rupo, you can go to the last slide while I send you a link that we can do a couple of simulations. Go to the last slide. I'll be emailing you a link right now. The last slide. Let's do a Q&A while I email you the link, right? So let's go back to the Q&A.
Okay, so the last slide is the one with the table task.
No, the last one, the very last one.
Okay. Okay, where your picture is.
Yes. So let's do a Q&A, and then we'll be doing 1 or 2 simulations for this particular section before we go, right? I saw a question come up. There was one last question that was typed in. We can go back to that question while I send you the link.
Sure. So there was a question from Henry Drea, and it says, if you talk of children and wife, do you include them in any if they are in Ghana and have not been in the US before?
That is a great question. Who was that again?
Henry Drea.
I don't know how to answer that question. I'm going to read what the tax rule says, okay? And I'm going to read it out of my head. It says that the children should be living in the United States. As a matter of fact, should be living in the household for at least 6 months. I know that most of us from our society send our kids to Ghana. I know that. And I know that we do claim them. But what the tax rule says is that the children should be in the United States for at least 6 months of the whole year.
Got you. All right. So the next question here, let's see what the next question is. 1 second here. All right. So the next question is also coming from, I think, Dr. Nyokai. He said, if you are a sole member LLC and you want to file the business taxes with your personal taxes, can you still file jointly with your spouses?
Yes.
All right, great.
So if you have that sole member LLC, you are going to prepare what is called a Schedule C. So the Schedule C will take everything, which is your profit and losses on your LLC, and bring it back to your 1040. So you can join, you can do that with your spouses. As a matter of fact, it's a good way to save money on your taxes, because if your personal, if your LLC make losses, you can write that off your personal taxes.
Yeah. All right, great.
I think somebody had their hand raised.
Yes, senior. First, before I think the first one will be Senior Sapon. Senior Sapon, you can go ahead and ask your question, and then Stephanie.
Okay, thank you very much, and thanks, Pro and Prof. I think mine was more of a clarification for the lady who had asked about if you are married or single, since the tax deduction amount is twice. Would it make any difference if you filed single or if you filed jointly? And I think it's all got to do with the mathematics of the earnings, because A plus B, if the husband makes A and the wife make B, even though you are going to be subtracting 13,850 from each, when you put the A and B together and you get another number C, taking the 27 from that C gives you a better return than doing it separately at 13,800 for each of the A and the Bs. Because like what Professor just illustrated, the tax bracket, you fall into a different category. It's segmented. So the total income will put in a different bracket. And that more often than not is better when you join the two incomes rather than doing it separately. And also if you file separately, and I believe, Prof, help me out if I'm wrong, you file separately and you realize you would have made more if you had filed jointly, you can always file a correction. I believe the IRS will allow you to do that. So that's just a contribution.
Yes, thank you so much. Yes, the IRS rule states that use the filing status, as long as you qualify, use the filing status that will give you the maximum return. That's what the rule says. So if you file married filing separately and you found out later on that jointly would have helped you, if you've already filed your return, you can do an amendment. The one thing that I wanted to throw in is that if you haven't filed your taxes yet this year, do not file. Wait till after January 29th when the IRS opens the e-filing. Why am I saying that? Because there's a lot of tax rules that are being changed right now as we speak. There's one that the senators are debating on, which is the child tax credits. There's a debate if they should give an additional $1,000, right? So before the IRS timeline for us to file, if you haven't filed, do not file. Wait for the IRS to let us file so that those will be updated in the tax system. But to my point that I was saying, if you've already filed, you can always do an amendment to change it and the IRS will bring you your money, the difference. To my friend Albert, who asked the question earlier on about the children, I'm going to read to you what the rule says. It says to be claimed as a dependent, the child must be a US citizen or a resident of Canada or Mexico for at least part of the year, right? So we all know what resident means, right? They have to be in this country for part of the year. So that is what the rule says. Propro, did you receive my email?
Yes, I have it.
By the way, my phone number and my contact is on there on the Q&A. But I want you to share your screen and click on the link so we can do a couple of simulations. This will take about 2 minutes, and I want us to practically see what happens with the different filing status and all those things. Practical example, which I promised at the beginning. It will take about 2 to 3 minutes, I promise.
All right, 1 second here. So. Okay.
And this link, if you don't mind, you can drop it in the chat so people can have it. It's online. Anybody has access to it. So for Stephanie and Senior KS, you can use this link to do the simulation, right? So let's say if you want to do filing separately or filing jointly, you can do your own simulation and see which one gives you the best return, all right? It's called Taskcaster or Task Calculator. So in our first example, in our first simulation, we have a single taxpayer. So scroll up and select single. This taxpayer is an IT consultant and his age 35 years. So put in 35. And this is all hypothetical, okay?
Okay.
So where it says your age, put in 35.
Okay.
Right, this taxpayer is single and he cannot be claimed as a dependent. So click continue. And you can drop the link in the chat for people to do it on their own.
Yes, I've done that.
He made an income of $85,000. So put in $85,000. And this amount comes from our W-2s box 1. So when you receive your W-2, 85,000, box 1, that's the amount, right? So look on the right side where it's got a green. All of a sudden, this person owes $10,000, $10,961. Their tax bracket, which I just showed you, is the 22% tax bracket, but their effective tax rate is 15.4%. The reason is that they got a deduction for being single, right? Remember the single deduction, 13,800 that I showed you earlier on.
Yeah.
So that 13,800 has been subtracted from their 85,000 to bring their effective tax rate to 15.41. However, on your W-2 box 2, there's a federal withholding. So in this example, let's say 12,500 was withheld. So put in 12,500.
In box 2?
In under the 85,000 where it's blinking.
Okay.
And let's see what happens.
So
12,005. And click anywhere. Did you put in 12,005?
Yes, under enter your unemployed income.
No.
Okay.
Withholding. Sorry, the next line. Take it and put it to the next line. I'm sorry.
Okay, so here.
Yes.
12,500. Okay.
All right. Now let's see. Did you all see what happened? All of a sudden, we went from owing $10,000 to now the IRS owes us $1,539. This is because 12,500 was withheld from their W-2. All right. So they went from owing money to having money. If any amount less than the 12,500 was withheld, let's say they withheld 10,000, change the 12,000 to, let's say, $8,000. Let's make it simple, $8,000. Now they owe the IRS 12,961. Okay. Does it make sense? All right. So let's change it back to 12,005. And in this same example, we are going to go back up all the way up, and then click on the general info. And then we are going to change the filing status to head of household. And let's see what happens to their refund. Okay. Right. So changing it from head of household, from single to head of household, went from getting $1,500 back to getting $4,600 back. Okay. Now let's go to the dependents. For you to claim head of household, you must have some dependents. So scroll down to dependents. Click on keep my family, go down to my family. Click on that. And then let's put in one dependent. Put in one. And click anywhere. All right. So because they have one dependent, their refund went from $4,600 to $6,600. The reason being that they are getting the child tax credit, right? Click on view more in the green box. View more on the green. View more. Yeah, right there. If you look down there, do you see the credits for $2,000? That is the child tax credit. And then let's do our last example. This same example, we are going to go back to the family. No, go up all the way to general info and change it to marriage filing jointly. And let's see what happens. right? Did everybody see what happened? Of course, there was an earlier question that asks if you do married filing jointly, does the other spouse have to file? All of a sudden, as soon as we change it to married filing jointly, there's a section for your spouse's age, right? Do you see that beside the 35? So in our example, let's put 32 for our spouse, 32 on the spouse. The next one.
Oh, yeah.
Yes, because you cannot file without a spouse's age, the spouse's social security number, and the spouse signing. And because we are two married filing jointly, let's go to the dependents, same income, okay? Let's go to the dependents, the family section, and add one more kid. So let's make that two kids under 17. And let's see what happens to your refund. Thank you. So in a nutshell, I've just shown you how the filing status changes your tax return. Your filing status, single, head of household, and married filing jointly. We all saw how your tax returns can change tremendously with using those taxes. All right. So this is our simulation. Like I said, you can do it on your own. Click on the link, bookmark it, and anytime you have any questions, you can go in there and play with it. Okay. And then if you have any questions, you can reach out to your tax accountant, or you can reach out to me or anybody else who can help you with that. Thank you so much, guys, for having me. And I'll stay behind for any questions that you may have.
Awesome. Thank you. Thank you so much, Prof, for this wonderful presentation. At this point, we have room for questions, and Prof will answer. So let's start with Emmanuel Asare.
I think I'll just go with just literally, you opened my eyes to a lot. I think some of us, we just been playing with this tax thing. You just let a tax person just play with whatever numbers they want to play with. And I think we've been really educated today. So I'll be contacting you. I've made a few mistakes in the past, and I think I need some corrections here. I filed head of household, with all that, and a part of me kind of get a little scared because I'm scared I'm going to owe and all that. But I've been really educated, and really thank you for this. I chanced upon this when I was scrolling through my phone, and I saw your status that you were having this, so I just jumped into it, and it was really, really educational. Thank you.
Awesome.
You're very welcome.
Thank you very much. All right. Any other question? Any contribution? Any suggestion? Anyone want to say something else?
Good evening, Prof. So for the link, well, I joined late, but what you were working on with the assimilations, are you able to share the link again?
Yes, I did. It's on the chat. If you go to the chat, you should see it there.
Okay, thank you. And also one last question. Do we know, I heard in the news somewhere that they were gonna up the child tax credit. Do we know how true that is or how soon that will be?
Yes, I spoke about that a couple of minutes ago, and I told folks on the line that if you haven't filed your taxes yet, you may receive your W-2. As a matter of fact, I got my W-2 yesterday, right? And you'll be tempted to file your taxes. Do not file until after the 29th of January. Please do not file because it's still being talked about. There's a little bit of confusion in the Senate or whatever it is, the House. I'm not a politician, even though I did politics in Adisadel, but I'm not a politician. I really hate politics. But they are still deliberating if they should increase the child tax credits from $2,000 to $3,000. Of course, the Democrats have a different opinion. The Republicans have a different opinion. And the government was about to shut down a couple of days ago. I think it was today. But they are all doing all these different things to get different stuff. So I know the shutdown has been punted to March for them to be able to get some of these things in. So there's a talk about increasing that to $3,000 for last year. And if you file your taxes now, you may not get it. Of course, you can do an amendment, but amendments are a pain in the butt. So wait until January 29th.
Okay, thank you, sir.
All right, great. I think Senior Alfred, your hand is up.
Yes, thank you very much. This was this is very valuable information, and information is the currency for success in the US. So I really appreciate this. My question is, if you go to school on the side, or you're doing the taxes for students, how do you know, or do you have a suggestion of where you can find how much educational credit you're entitled to? If you do a master's, if you do undergrad, how do you know where to look for how much educational credits you're entitled to?
All right, thank you, Alfred, for your question. You can always go on Google. That is a safe place to go. But if you go to school and your school is accredited, then your school should be sending you a form, a tuition form. I believe it's called 1098T.
Mhm.
So you should expect to receive the form. The one thing that most companies do now is that they don't actually send the form. So you've got to go to your school account and log in and then look for the tax forms and get it. Because I had a couple of clients last year who were in school, but they did not receive the letter from them. And right over the phone, we were able to go into the account and the letter was there. So for you to get that credit, go look for your form 1098T and then get it, and then everything will be there, right? So your tuition that you paid and everything, all those are deductible. So you can take advantage of that.
Much appreciated. Thank you.
But make sure that your school is accredited, okay?
Yes, yes. Thank you. Thank you very much.
And then the credits are called American Opportunity Credits and the Hope Lifelong Credits, Hope Lifelong Learning Credits. And the form is called 1098T, okay? So you qualify for that if your school is accredited, if it's a post-secondary education, if you paid out of pocket. Of course, if you had any scholarship, they're going to back out the scholarships, right? But it's a good credit for now.
Okay. Thank you very much.
You bet.
All right. Dr. Kwesimienu, your hand is up.
Prof, good evening, and thank you very much for this talk. I was working it out because of the kids, but at some point I think I heard you talking about additional withholdings, and I missed some of it because I was working out of room. Can you tell or give us advice? What's the best way to use that to take advantage of that tool? Like how to benefit? Because that's my question.
Of course. Thank you so much, Dr. Menu. The additional withholding is so important, right? Especially if you make, I saw a question, is Propo School eligible for the tuition stuff? I think Propo School is non-profit, so.
Exactly.
So if you make money, let's say if you make over $85,000, right? And if you look at the tax bracket, and you, in our first example, the IT guy was making $85,000 and he withheld $12,500, right? And we saw that he was going to get back $1,500. Then I had Pro change it, the withholding to $8,000. Then all of a sudden he owed or something, right? In our first example. So if you are in a high income bracket and you file taxes and you always owe the government, go to your HR and tell them that you want to do additional withholdings. It's very, very, very important. Otherwise, every year you'll be owing taxes. And it's so frustrating to some clients when they come in here and they owe taxes. Go to your HR, tell them that anytime you file taxes, you owe money, so you want to do additional withholding. Use the link that I just sent you to do the casting for your taxes, and you'll be able to tell how much you need to withhold, how much more you need to withhold, okay? When you do the simulation and you've been withholding 15,000 and that is not enough, the software will tell you how much more you need to withhold.
Thank you. Thank you.
And I saw another question, if the donations to Adisadel Old Boy Association was tax deductible. Yes, it is tax deductible. So when you do your donations, make sure you're also claiming that as well. Of course, for it to be tax deductible, you have to be in the itemized section to do that, okay? You have to be itemized, and if you get a standard deduction, then you're not getting a tax deduction. But if you itemize, it's part of the items that will put you into the itemized deduction for you to deduct your donations to the Adisadel Foundation and Adisadel Old Boys Association.
Great. All right. So we have Senior Bernard. Senior Bernard, your hand is up.
Hello, Prof. One last question. Last year I received, I guess something from my insurance. I guess the insurance company gave me a kind of a tax form. Are we supposed to be adding that to our taxes? Is it going to make any difference if we add it to our taxes, or how does that work?
It depends on the kind of insurance, right? When I was talking about the tax savings strategies, one of the biggest tax saving strategies is life insurance, right? That's good, but it depends on the kind of insurance document that you had. So you can, if you have my number or my email, you can send it to me, send me a screenshot, and let's talk about it. But if you look at the forms itself that was sent to you, if it's meant for you to file your taxes, they'll write it on the form. If it's for informational purposes only, it will also be written on the form. So they'll tell you that this is for your information. You don't need to file your taxes with this. So it will say it somewhere on the form. But if it's something that you need to file with your forms, because I know that if your company is paying your health insurance or life insurance, you do get some forms, right? 1098A and all those 1095C and all that stuff. Some of them are for informational purposes only. Some of them are for filing. So it depends on what form you are talking about.
Okay, it was just like a regular health insurance. So I'll double check it again to make sure if it's just for informational purposes.
Yeah, it will say somewhere on the form.
Okay, thank you.
All right, guys. Any more question? Prof, now what about someone who got a job in DC, lives in Virginia, work in Ohio part-time? Now, when this person is filing taxes, will the person have to file taxes both in Ohio, Virginia, and if the person works for federal government but based in DC, will the person also have to file a DC tax?
This question is so difficult that I've got to charge you before I answer, okay? So the IRS define your tax home as where you live, okay?
Okay.
So there are different scenarios for tax purposes, and it can get really, really complex if you work in multiple states. But where you come home, right? Where you come home, put this in mind, where you come home is your tax home. So if you live in Virginia and you work in DC, your tax home is Virginia. If you live in Maryland and you work in Virginia, even though you are making money in Virginia, your tax home is Maryland. So if you look at your W-2 and Virginia withheld taxes from your W-2, you've got to file a non-resident taxes in Virginia to get that money back because you'll be paying your taxes in Maryland. There are rules called reciprocity rules, and every state have their own rules, right? So Maryland and Virginia have those rules that if you work in Maryland, you live in Maryland and you work in Virginia or vice versa, you don't have to pay taxes in where you work. So there's that reciprocity rule. So you've got to go to your HR and change your tax forms to Maryland so that they'll be withholding your taxes in Maryland, even though you work in Virginia or DC. Does that make sense?
Yeah, makes sense.
Yes. But if for some reason you look at your W-2 and your taxes were withheld in both Maryland and DC, then you have to file a non-resident return in the state of Virginia so that they can give you your money back.
Got you. Got you. Thank you so much. All right, guys. Any more question for Prof? And I say, Prof, if you are taking new customers, are you available to take new customers?
Yes.
We're open 24/7.
All right. So if there are no other questions or
please, I have a question. Sorry.
Okay, sure. Henry, please go ahead, Henry.
Yes, so I received this form, I think it's from 1099G, and it was talking about like a refund I got from like the state of Ohio, and I didn't really get what they were trying to say whether, I don't know whether they wanted me to like include the refund I received as an income earned or something like that. But I got it. They said this is not a bill or notice of refund, but they were alluding to some things like that, and I really didn't get it. So I wanted to ask you if you have any idea about it.
Yeah, so for the 1099-G, it is when the government pays you money. And sometimes you get that if you got a state refund the previous year. Sometimes.
Yeah, that was the
if you got a
case.
state refund, is that the same amount?
Yeah, that was the case, yeah.
Yes. So if you file your own taxes, let's say if you use a tax software, you can type in 1099-G and it will pop up and then put that information on your 1099-G there. You do get that sometimes when you get your state tax refund. And just put it in the tax software. If you have a CPA and you're going to file your taxes, just include it in so that he can include that.
Okay. Otherwise, is it like included as part of the income lines?
No, it's not included per se, but I think for the federal government tax filing, if you itemize your deductions, they need that number. They need that amount that you got from the states to calculate something in the background, but it's not included per se.
Okay.
So it's because you probably itemize. So they're asking you if you got some money from the state. That's why. But if you want me to look at a specific case, you can also reach out to me.
Sure. Thank you very much.
All right, great. So I think that Professor Atuahene has delivered beautifully, and let me see. Do we get standing discount? Captain was asking if we get a Aruba member good standing discount. But I think that Prof has nailed it very well. We are very grateful. Thank everyone for coming. This is just the beginning of many things that many seminars and workshops that we'll be organizing. Our focus this year is to empower and to train and to build enough capacity to take over the nation. So at this point, I will hand over back to our president, Leo, Dr. Leo Ryder, to wrap it up, and then we can end it. Dr. Leo Ryder.
Well, thank you everyone so much for taking the time off, like I said earlier, to join this presentation. Without you, this is pretty much useless. So we thank you for taking time off your busy Friday night to join this. And, you know, Prof. Atuahene, we owe you a debt of gratitude for taking the time to put together the presentation and also answering our questions. These are things that we should be paying our accountants for if, you know, you are not the one filing for us. But we thank you so much for always doing this service, and to AOBA and also to our friends who join us. So thank you all so much, Pro as well. Thanks to Jagels for always hosting these events. So with that, I would like to, you know, wish everybody a happy weekend, especially those of you who are enjoying the snow and everything. Just be safe out there and enjoy the rest of your weekend. Thank you.
All right, thank you guys, and we'll get the recording circulate as well once it is out. Thank you guys. Have a blessed evening and good night.
Thank you.
Thank you.